Welcome to our channel, where we explore the latest in economic trends and investment strategies. Today, we delve into the pressing concerns surrounding inflation in 2024 and its potential impact on investors. From recent data fluctuations to Federal Reserve policy shifts, we'll dissect the factors causing nervousness among investors and discuss strategies for navigating these uncertain times. Join us as we unravel the complexities of the current economic landscape and empower you to make informed investment decisions. Don't forget to hit subscribe and turn on notifications to stay updated on all our future content. Let's dive in. Recent inflation data and its implications. One significant driver of investor unease is the analysis of recent inflation data. While there had been hopes of a steady decline in inflationary pressures, the January data revealed a slight uptick, contradicting these expectations. This deviation from anticipated trends has led to concerns that the progress in curbing inflation might be temporary, reigniting fears of its resurgence. Investors closely monitor such data as it provides crucial insights into the underlying economic conditions and informs investment decisions. Federal Reserve's monetary policy. Another pivotal factor contributing to investor nervousness is the Federal Reserve's monetary policy stance. In response to mounting inflationary pressures, the Fed had raised interest rates in 2023 as part of its strategy to combat inflation. However, there are indications that the Fed might adopt a different approach in 2024, with hints of potential rate cuts later in the year. While such a move could initially assuage concerns among investors, the possibility of a resurgence in inflation raises questions about the Fed's future policy actions. If inflationary pressures intensify, the Fed may find itself compelled to maintain or even increase interest rates, a scenario that could have significant ramifications for financial markets and investor sentiment. Market expectations and their influence. Investor nervousness is further compounded by the dissonance between market expectations and unfolding economic realities. Many investors had anticipated a more rapid decline in inflation, coupled with earlier rate cuts from the Federal Reserve. However, any deviation from these expectations has the potential to trigger volatility in financial markets. The misalignment between anticipated outcomes and actual developments underscores the inherent uncertainty that pervades investment decision-making, particularly in the face of complex macroeconomic dynamics. Potential consequences of inflation resurgence. The apprehensions surrounding inflation in 2024 are grounded in valid concerns, as its potential resurgence could trigger a cascade of adverse consequences with profound implications for both investors and the broader economy. Inflation, the persistent increase in the general price level of goods and services, has long been recognized as a threat to economic stability and financial well-being. Should inflation indeed experience a resurgence, it could lead to a variety of negative outcomes. For investors, this may entail diminished purchasing power and erosion of real returns on investments, particularly in assets with fixed income such as bonds. Moreover, heightened inflationary pressures often coincide with increased market volatility, as investors grapple with uncertainty and adjust their strategies accordingly. In addition to these market-related implications, inflation can also have broader economic ramifications. Rising prices can erode consumer confidence and curb spending, potentially slowing economic growth. Market volatility. One immediate repercussion of heightened inflationary pressures is increased market volatility. Fluctuations in stock prices and other financial assets are likely to occur as investors react to shifting economic conditions and adjust their investment strategies accordingly. The uncertainty stemming from inflation concerns exacerbates market volatility, creating a challenging environment for investors seeking stable returns. Higher borrowing costs. A resurgence in inflation could also lead to higher borrowing costs for businesses and individuals. If the Federal Reserve opts to maintain or raise interest rates in response to inflationary pressures, the cost of borrowing is likely to increase. This, in turn, could dampen investment activity and consumer spending, thereby exerting downward pressure on economic growth. The prospect of elevated borrowing costs underscores the importance of proactive risk management and strategic planning for investors, particularly those with exposure to interest rate-sensitive assets. Reduced investor confidence. Continued inflationary pressures have the potential to erode investor confidence, impacting investment decisions and overall market sentiment. Heightened uncertainty regarding future economic conditions may prompt investors to adopt a more cautious approach, leading to reduced risk-taking and capital allocation. Moreover, a loss of confidence in the efficacy of monetary policy interventions to control inflation could further undermine investor sentiment, exacerbating market volatility and complicating investment strategies. Navigating the current economic climate. In today's economic climate marked by uncertainty, investors must proactively engage with an informed approach to effectively maneuver through the evolving landscape. This requires a comprehensive understanding of the factors influencing investment decisions amidst concerns over inflation and market volatility. Firstly, staying well-informed about economic developments and analyzing relevant data is crucial. Monitoring inflation indicators, central bank policies, and macroeconomic trends provides invaluable insights for adjusting investment portfolios accordingly. Diversification remains a cornerstone strategy, spreading investments across various asset classes to mitigate risks associated with market fluctuations. Additionally, maintaining flexibility and adaptability is essential. Being prepared to adjust investment strategies in response to changing economic conditions enables investors to seize emerging opportunities while minimizing potential losses. Seeking professional guidance can further augment decision-making, offering personalized insights aligned with individual financial goals and risk tolerances. Stay informed and analyze data. First and foremost, investors should prioritize staying informed about economic developments and analyzing relevant data to inform their investment decisions. Monitoring inflation indicators, central bank policy statements, and macroeconomic trends can provide valuable insights into the prevailing economic conditions and guide portfolio adjustments accordingly. By leveraging timely and accurate information, investors can better position themselves to capitalize on emerging opportunities and mitigate potential risks. Diversify portfolios and manage risk. Diversification remains a fundamental principle of prudent investing, particularly in times of heightened uncertainty. By spreading their investments across different asset classes, sectors, and geographic regions, investors can mitigate the impact of adverse market developments and reduce portfolio volatility. Additionally, implementing risk management strategies, such as hedging and asset allocation rebalancing, can help safeguard against potential downside risks and preserve capital in volatile market conditions. Remain flexible and adaptive. Flexibility and adaptability are essential traits for successful investors navigating dynamic market environments. Recognizing that economic conditions can evolve rapidly, investors should be prepared to adjust their investment strategies in response to changing circumstances. This may involve reallocating resources, reassessing risk tolerances, or revising long-term financial goals to align with shifting market dynamics. By remaining nimble and responsive, investors can effectively capitalize on emerging opportunities while minimizing potential losses. Seek professional guidance. For investors navigating complex market environments, seeking professional guidance can provide valuable expertise and perspective. Financial advisors and investment professionals can offer personalized insights and recommendations tailored to individual financial goals and risk profiles. By leveraging their expertise and experience, investors can make more informed decisions and optimize their investment portfolios for long-term success. In conclusion, the concerns surrounding inflation and its potential resurgence in 2024 have significant implications for investors and financial markets. While the situation remains fluid and uncertainty persists, proactive risk management, informed decision-making, and strategic planning can help investors navigate the current economic climate effectively. By staying vigilant, diversifying portfolios, and remaining flexible in their approach, investors can position themselves to weather market volatility and capitalize on opportunities for long-term wealth accumulation. Thank you for tuning in. We hope you found today's discussion on inflation concerns and investor strategies insightful. Remember to like, comment, and share your thoughts below. If you haven't already, subscribe to our channel and hit the notification bell to stay up to date with our latest videos. And as always, for personalized investment advice and expert insights, don't hesitate to reach out to our team. Until next time, happy investing.